Sharp recovery from the opening lows on Dalal Strait. Frontline stocks clock some gains. Mid-cap index also recoups losses to trade flat. IT and financials gain is the pharmaceutical and metal stocks which drag.
Asian Paints turns negative for FY25 after second quarter numbers fall way short of estimates, especially on the volume growth. While the company is positive on the outlook for the second half, analysts remain concerned over the competition.
Tata Motors reports a weak second quarter as production hiccups and JLR impact sales, but the auto major expects a strong recovery in the second half and holds on to JLR's FY25 guidance. The stock revs up from lows.
Bitcoin scales a new peak to cross 81,000, riding on the Trump win optimism. Bets on the top cryptocurrency scaling to rise $90,000 amid expectations of Trump sweeping the US Congress as well.
Rupee touches a fresh record low and stabilizes after RBI steps in. All Asian currencies weaken between 0.1 to 0.5% amidst continuing dollar strength. You're watching us here on Halftime Report. I'm Mangla Malu. With me, Hormas Vatakia. The market looks a lot better than what it was on some days last week and a lot of days all of last 1 month or so. The good part is that the two top weights on the Nifty are doing extremely well for the frontline index. We have the Nifty Bank and the Nifty IT index. So both of them have ensured that the Nifty stays above that 24,200 mark. Whether it crosses past that 24,300 and the earlier important technical levels or not is something that needs to be monitored. For now, holding well. The other thing that we need to watch out for is the broader markets. At the bottom of your screen, we have numbers coming in from Devyani International. Of course, a large part of the revenue growth has been on account of the consolidations, the acquisitions, 49% jump in the revenue and margins coming in at 16% versus 18.8%. What's important to see is the same store sales growth of some of their key, brands, Pizza Hut as well as KFC, the like-for-like growth, something that we'll keep an eye out on. And apart from that, the commentary on consumer sentiment itself, because quick service restaurants seem to be stabilizing after a spate of weak performance for the last 7 to 8 quarters. We also have Jubilant Foodworks reporting their numbers. So is there a rub-off of Devyani's numbers on Jubilant Foodworks? Something that we'll keep an eye out on. Jubilant off highs right now, but largely flattish, reports its second quarter numbers. Hi, Hormas.
Good afternoon, Manglam. It's a good-looking market, at least on the benchmark indices, as you mentioned, right? The top two weightages, the banks and the IT stocks leading the Nifty higher at one point was up even above the 24,300 mark. But no complaints as of now. Positive start to the truncated week. Can't say the same, though, for the broader markets because there are a lot of extreme earnings reactions that are coming in. Highlight some from the positive side first. The Shipping Corporation that reported results on Friday and the top gainer on the Nifty 500 this morning is up almost 12% as we speak. And that is a positive earnings reaction of 13.5%, now building on to those gains. And some of the MFI players on the negative side reporting negative results. Equitas Small Finance Bank is down almost 6%. MapmyIndia too is down 6% as well. So some broader market reactions on the extreme end on the other side. But the stock in focus, as it has been all through the morning, has been Asian Paints after another weak quarter in the September quarter as well. And so not good going for Asian Paints.
Not good going for Asian Paints. It's been the stock of the day, but it's been the discussion of the weekend. The numbers came out on Saturday. The stock down about 8%, one of the biggest intraday falls that we've seen in the stock. It's important because Asian Paints typically reports its numbers first among all the paint companies. This time around, it's one of the last to report. And the street wasn't expecting too much from the sector this time around, but they were expecting some sort of outperformance from the leader. That wasn't the case. In fact, not just have they not outperformed, they've actually underperformed the entire sector when it comes to the revenue, are down about 5.5% as against others, which have actually shown either a marginal decline or a marginal growth this time around. The second part, the volumes, they declined by about 0.5%. The street was working with a number of around 6 to 8% growth. And this is the first decline ex-COVID in the last 12 years or 48, 50 quarters. So that, again, was one of the reasons why there was disappointment. And that disappointment flew through to the bottom line as well. The EBITDA actually declined by 28%, margins declined by 500 basis points, and the net profit also was down by around 44%. Of course, the net profit had an element of exceptional 124 crore, written down of their investment in White Teak Co. and 56 crore worth forex loss in Ethiopia. But, overall, the revenue was weaker because of a couple of things. Weak consumer sentiment, prolonged rains and floods in part or some parts of the country impacted their overall performance. What we need to know, however, is that are things looking good? And secondly, how much of that could actually be on account of competition as well? Why do I say that? Because if you look at the management commentary, the conference call is today at 4. So up until then, we just have the management commentary to reckon with. Out there, they've actually alluded to increased sales expenses and increased rebates to dealers. Typically, companies do that to push their product when, there are competition or competitive intensity. And the second part is that employee expense itself as a proportion of sales is higher by about 140 basis points year on year. There's a 13.5% increase in that. So is the company looking to protect its employees while incentivize dealers to push their product? These point towards some sort of competitive intensity. We'll keep an eye out on that. Obviously, the stock with its decline is down about 30% from its highs, on track for a negative financial year return. If that were to happen, it would be the first in the last couple of years and the third in the last 20 years where the company reported a negative financial return.
Telling numbers from Asian Paints. Mangalam, thanks for that. Continuing with our earnings focus, Action Construction is in focus after its second quarter. The company's EBITDA grew by 22%. Net profit also grew almost 30%. Saurabh Agrawal, who's the executive director of the company, who's joining us this afternoon. Saurabh, good afternoon. Thank you for joining in. Let's start off with the road ahead as well. You had earlier guided for a 15 to 20% growth going forward. Do you stick to that guidance for the rest of the year, considering how your first half has been? And what's the second half looking like?
Yeah, good afternoon. I think we are very much on track for our 15 to 20% growth in this year. We did anticipate that things would be slower in the first 2 quarters, and that is what we had planned for. So we're very much on track with respect to 15 to 20% growth. And if you look at the history of our company, about 55% of our revenue comes in the second half. So looking at that, and obviously the market sentiment has definitely increased October onwards. The order inflows have also increased. So we are very confident that a 15% plus is a given, and it could go up to 20%.
All right, 15% plus is given, could go up to 20%. The first quarter was obviously impacted by the elections. The second quarter was good, one of the best second quarter evers. And the third quarter, there is the Maharashtra election as well. So would there be an impact on account of that? That's point number one. And secondly, if you could give us, what is the current utilization of your equipment, and what are the yields on that equipment? How are they likely to pan out going ahead?
I don't foresee any impact of the Maharashtra elections because our product go everywhere, even in the export market. So I think all that is pretty okay. And with respect to our utilization levels, I think we've been working around 65 to 70% for our main segment in the last quarter, and that continues in this quarter. Here, I would just like to add that we'll be further adding capacity, which is already underway, the expansion. So we will have more capacity in our main segment, which is the cranes, construction equipment, but landing segment by Q4. And our utilization currently are about 65% plus. And in the agri segment, the utilization is close to about 25-30%.
Saurabh, you mentioned in your earnings call as well that you're expecting good sales in the current quarter because of the fact that you're expecting some pre-buying ahead of the transition to the BS5 norms. Could you quantify that? What kind of pre-buying are you anticipating?
See, ideally, about 10 to 20% extra buying happens whenever there is a generation change. And right now, let's say in quarter 4, BS3 machines are going to BS5 and BS4 are also going to BS5. So that could easily add an additional 10-20%, especially in the month of December. I would say second half of November onwards. And we are hopeful that will happen, apart from the increased momentum which is already in place.
Right. With your utilization increasing, what are the kind of margins that you foresee from both your segments in this year and the next?
See, on a whole year basis for the current year, I would say that we should be somewhere around 17 to 18% level, EBITDA level. And with our utilization increasing further or our operating leverage playing in, we believe that there is always a point, about a percentage point increase possible in EBITDA with every 500-600 crores increase in turnover, and which has been playing on for the last 2-3 years. So that this growth with respect to EBITDA is possible if the company intends to do so.
So fair to say that 16 to 17% around about margins for the full year is achievable.
Yes, easily.
Right.
And
Now,
hopefully.
right. We've spoken about an order from the Defense Ministry as well, Saurabh. You've won a couple of orders in the month of August and September as well. You're expecting either in the third quarter somewhere around 300 to 400 crore worth of orders. Have you heard something from the ministry? What's the progress on that front?
It's in final stages, and hopefully it should get through in November, if not in December. So this is an order which is slightly bigger than 400 crores. This will be our single biggest order ever. And also, obviously, the biggest order from the Indian Army. So I think this will be a short and arm with respect to our defense initiative which we have been taking. And we wanted to go between 5 to 10% with respect to the defense contribution to our business. And with this order in hand, I'm sure in FY26 and FY27, we would be somewhere 6 to 7% at least with respect to our revenue contribution coming in from defense.
Wonderful. So defense increases from 2.5 to 3.5 in this year, along with this order, and 6 to 7% in the next couple of years as well. What about exports? Because that is something that you were looking to increase as well. Where do you see that as a proportion of your overall sales going? Because it's 8% of your sales, but at the same time, the outlook in global markets is a little bleak.
Our medium to long-term plan is to take it between 10 to 15%, maybe even up to 20%. And we are working on that plan. But here I would just like to add that in the short term, last quarter, the contribution was 5% because some orders and deliveries have got shifted into quarter 3. So hopefully we should gear up within the second half with respect to our exports also for the current year. But going forward, medium to long term, we are targeting at least 10 to 15% and aiming to 20%.
Saurabh, the first half was not a very good half for the agri equipment business. It was down almost 40% in the first quarter, was almost flattish, just a slight 3% growth in the second quarter. How is the second half shaping up for the agri equipment business? And if you could also tell us how much of your overall mix is the agri equipment business?
See, agri business is about 8% of our revenue. And but if you look at the half-year basis, we have definitely dropped in business. But if you look at year-on-year basis for the quarter, we have grown by 42%. The drop has come primarily because of the export orders. Last year, in the first half, we had some significant export orders from Africa, which were under execution. So I'm sure this pace will pick up in the second half as we have more export orders from some other countries. So hopefully, we'll be able to make up for that in the second half of this year. And like I said, the contribution is close to 8% to our revenue.
All right, Saurabh, thank you so much for sparing time and joining us on the show to take us through the quarter gone by. Wish you good luck for the second half of the year as well. The management of Action Construction Equipment, the stock off the lows of the day as we speak, currently trading at the flat line. Time for a short break. Up next, we'll be joined by Ankit Thakkar, the CEO of Jupiter Lifeline Hospitals, to discuss the road ahead for the company. Stay tuned.
Welcome back. Before moving on, let's talk about a couple of stocks. We have Trent, which is the top Nifty gainer. The Goldman Sachs initiating coverage, doing extremely well for them. The stock has recovered about 5% from lows. Mind you, it's still down about 22% off its all-time high. Post numbers saw a big cut last week, down about 10%. But now from the lows, it's seeing some bit of respite. And Goldman Sachs believes that there is room for more. They have a target price of 8,000 on the stock. The other one I'm looking at is Devyani International. While we are awaiting the same-store sales growth data for a lot of their brands, the company has gone ahead and informed the exchanges of 3 new agreements that they've signed, franchise agreements. One of them is Tea Live, which is basically a Malaysian tea and beverage chain. The second one is New York Fries, which is founded by Recipe Unlimited, which is Canada's largest multi-channel restaurant company. And the third one is Sanook. Now, Sanook is a Singapore-based leading and most popular brand specializing in authentic Thai and Asian cuisine. So, of course, expanding their palette of offerings, so to say, for Devyani International. We'll keep an eye out on how these add to their growth going forward as well. All of this while we await the same-store sales growth numbers. But let's talk about more.
The Devyani International, they've just come up with their presentation as well. It shows the KFC India same-store sales growth is down almost 7% for the quarter. is what the investor presentation is showing as of now. For Pizza Hut India, the same-store sales growth is down 5.7%. That is what the investor presentation is indicating. So same-store sales growth figures coming in. And for Costa India, the same-store sales growth currently is at around 8.7% for the quarter.
All right, so we'll keep an eye out on that. Get some more details from the presentation as well. Thank you for that, Hormaz. Move on. Let's talk about Jupiter Life Hospitals. The average occupancy increased to about 67% in this quarter. The results were good. The stock is up around 4.5%. The important point, what happens from here on? Ankit Thakkar, who's the CEO of Jupiter Lifeline, joins us now. Ankit, there was good performance. The occupancy increased from 62% to 67%. The inpatient volumes for the first half up almost 11%, similar as the outpatient volumes as well. And average revenue per occupied bed moved to around 57,700. So there was growth on all parameters, and that's reflecting in our overall performance as well, with the net profit increasing about 39% in the second quarter. The question is, what happens in the second half and the next year? What's the kind of occupancy that you're targeting for the full year with the average revenue per occupied bed? And similar are your targets for the next financial year as your newer hospitals start to mature?
Yes, so on the occupancy front, we just added 22 beds in this quarter, which have started getting utilized. I think in the next half, we should see a good occupancy on these new beds in Pune. After that, we have one more opportunity to increase 12 beds in Pune. That would be the end of it for brownfield expansion in Pune. In Indore, we have achieved about 60% occupancy in this quarter. And we are in the process of building 75-80 more beds, which will get commissioned in the coming quarter. So you will have a greater capacity available to get occupied in Indore in the next quarter and the next financial year. As far as the newer hospitals are concerned, Dombivli is progressing well. In calendar year 26, we should commission Dombivli as well. And the second hospital in Pune is under regulatory clearances. We believe that we should get them in, again, the next quarter. So end of the financial year, beginning of next, that project should go underway as well.
Ankit, good afternoon. Thank you for joining in. Since you mentioned Dombivli, I'd get that point out of the way before we get to more numbers. What is the kind of capex that you have incurred for the Dombivli hospital so far? And what's the overall spend that you are planning for this hospital?
So we have spent about 120-25 odd crores already. We will spend another, let's say, 200-250 more in phase one. That should be up and running in 26.
Plan on funding that?
So we have cash reserves of 300 plus crores currently, and along with that internal accruals. So that should take care of it.
Right. Your margins have been in the 23 to 25% range, Ankit, over the last few quarters. Do you maintain that? You expect to remain in that range for the second half and for the full year as well?
Yeah, I think we should be in that zip code. I think 25, give or take something, is an optimal EBITDA margin as far as we are concerned. This first half, I think we are 23 and some change. Yeah, I think that is healthy given where we are.
Right. What about, any sort of acquisition when it comes to addition in capacity? Because you did allude to a lot of brownfield expansion and some augmenting of your rooms in, existing facilities, etc. as well. If you could give us a sense of the war chest that you have right now, and if you are looking at any acquisitions and geography in particular.
Geography is easier to answer first. Western India is our focus for now. We are honestly agnostic. If we get a good acquisition opportunity, we are happy to take it. But we think that we would want to maintain discipline while we grow. So we would not want to overpay just so that, we can hasten the revenue and acquire something so that we, start operating sooner rather than later. If it makes financial sense and if the opportunity is good, we are absolutely open to acquiring as well. We did that in Indore. But if not, we are happy to wait a couple of years and build it right.
Right. And while you did allude to, increasing occupancy with the base increasing and that getting utilized, you, I think, missed the point on average revenue per occupied bed. There was an increase in the first half of this year, in the second quarter as well. What is a number that is sustainable even as you increase your, footprint?
So for Thane and Pune both, I think we are at a mature clinical operation stage. So what that means is going forward, we would expect inflation-linked growth in ARPOBs for these two units. Indore is still in its growth phase, so for the next couple of years, we could see a little more than inflation coming from Indore with maturing case mix, with more complex surgeries, etc. Yeah, that should be the blended growth guidance.
With all the capacity that you alluded to that you have already added or you're planning to add, Ankit, say in Indore or in Pune for the second half, what does that do to your financials? How much does that contribute once it comes on stream?
So Pune, not too much more, 12 more beds. So I don't think it would have a huge meaningful impact on consolidated financials. Indore definitely will have a significant impact because 75 beds is pretty much 1/3 of what we have in Indore now. We believe that we should, achieve a good occupancy on those additional beds towards the end of the financial year. So in Indore, we should see a good contribution coming in with additional beds.
All right. Final question then before we let you go. On the payer mix, one was expecting a higher payer mix coming in from insurance and insurers, and that would do well for you in your ARPOBs as well. Where does that number stand at? Where does that go to? And also if you have any revenue coming in from international patients, where is that number headed? If you could give us a sense.
So on the payer mix, we have just about 1% from the government. Everything else is either self or managed pay. The broad split is about 55-45 now, 55 insurance and 45 out of pocket. As Indore insurance market improves going forward, we expect that number to go closer to or maybe even cross 60% of insurance contribution, which is what we are seeing in Pune. So on the payer mix, yes, insurance every year should become higher than it was the previous year. And international, we don't have too much of focus on international work. Nothing meaningful to report.
All right, Ankit, thank you so much for sparing time and joining us on the show. Wish you good luck for the second half of the year as well. The management of Jupiter Lifeline Hospitals. Take a short break. More on the markets and specific stocks on the other side. Stay tuned.
Welcome back. The market's off the highs. The F&O, perfect time to get in the F&O at midday, sort of set up. But before we do that, just keep an eye out on two important stocks. The first one, the Nifty stock, Apollo Hospitals. Just watch out for that. There's been a swift decline on Apollo Hospitals. And, the stock at one point had gone as low as 7,000 as well. The second one that we're looking at is Devyani International. Remember, we were talking about those numbers and the details coming by. But seems like now the street likes, the sort of acquisition plan that they've made with regards to master franchise agreements and the store rollouts which begin from April 2025 for T-Life, Sanook as well as New York Fries. But let's go back to the market. The Nifty's mildly off highs. It was at one point above that 24,300 mark. The Nifty Bank's doing well for that, and the mid-cap index too is underperforming. So we need to keep an eye out on a couple of things. One, two drivers today for the market, both the Nifty Bank as well as the Nifty IT index. The Nifty Bank actually has crossed important, moving averages. So we have the Nifty Bank, which is above both the 50 as well as the 100-day moving average. And alongside that, we have the Nifty IT index, which too has crossed past its 50-day moving average. So whether it sustains above that or not is something that we will keep an eye out on. Also, we will watch out for the market breadth, that even as the frontline indices are doing extremely well, we do have a lot of these PSUs doing well, BHEL, BEL, all of them added to this list of power financiers and power PSUs. The market breadth would be, also in focus, where we have more number of stocks declining versus advancing. And as we speak, the length of or the direction of these lines have only gone in divergent ways. So they are broadening out as the Nifty gives up from the highs. For the Nifty, the 24,000 put has been extremely active, telling you that there is support at the 24,000 level. 24,200 put writers too, equally active, telling you 24,100 would be a support as well. But on the way up, the 24,300 call writers were fairly active, and that explains why the Nifty fell off that 24,300 mark. The other reason also is that on the way up, even as the frontline indices like Nifty Bank and Nifty IT have gone ahead and crossed important levels, the Nifty, has still to cross the 20-day and the 50-day moving averages. A lot of stocks on our radar, some long positions being added on Trent, a lot of short positions being added on Asian Paints. And finally, we'll keep an eye out on Aarti Industries. Aarti Industries, after a big downtick post its results with a lot of open interest build up, may enter F&O ban today. So watch out for that one.
Slightly off the highs is the Nifty, but some pain in the broader markets. Mangalam, thanks a lot for that. Take a short break. The management of MapmyIndia joins us on the other side. Welcome back. In conversation now with the management of MapmyIndia, we're being joined by Rakesh Verma, the co-founder, chairman and managing director of the company. Mr. Verma, good afternoon. Thank you so much for joining in. For a company that is growing at 30 to 40%, your first half growth has been just around about 13.5%. What do you attribute the slowdown to, and do you see a recovery in the second half as we speak?
Answer is yes. Our second half is always much more loaded than the first half. And so we are pretty confident about what is happening at MapmyIndia.
All right, you're confident about what's happening in MapmyIndia. If you could tell us, if this revenue run rate of 13.5 is just a one-off, because earlier you were, growing at 30, 40%, that massive growth run rate that was there. So just wanted to understand if, that is the plan.
Okay, the plan definitely is to reach 1,000 crore goal in FY28, which we have disclosed last year. And we are on that track. Now, coming to specific half year, if you see the past also, we have always done much better in H2 than H1. And this is the way, that's what I meant when I said that we are pretty much on track.
All right.
What makes you so confident, Mr. Verma, of achieving that 1,000 crore revenue run rate by FY28?
See, if you look at FY28 and you look at the current scenario, approximately 30% growth rate year on year will get us there. So that's one. Our open order book of over 1,300 crore at the beginning of last year, and which we are building up more and more orders during this year, that's what gives us the confidence. Secondly, in the second half, there is a large amount of revenue that will be generating based on the customers' timing, that we call it as when we have to deliver.
Right. Just on the margin front as well, there is no quarterly trend where the second half or the first half is better for the margins of the company, through the year. But it's been around that 41, 42% mark for the last couple of financial years. This second quarter, it's down to 36%. So I just wanted to understand that, are you looking at margin recovery in the second half, or will this investment that you've planned out in B2C business for growing that continue? What are your thoughts on that?
Great. A year back, we disclosed that we would like to build the business on a long-term basis, in investing in international market, investing in drone, and investing in consumer business. Right. So if you look at our 36% and add to that 4% of what we have expense on and would continue to expense on consumer side of the business, where we have increased our downloads from 10 million downloads to, I'm talking about the Mappls app, to over close to 30 million downloads as of now. So answer is yes, we'll continue investing, but at the same time, our revenue growth will partially take care of that. And that's the way we look at building the business long term, which I mean 3 to 4 years.
But would that be possible, Mr. Verma? Because one of your core business, the consumer and enterprise business, which is almost 40% of your revenue, reported a decline in growth this time around, which at one point was growing anywhere between 50 to 70%. How deep-rooted is the slowdown in this segment, sir? What are your clients telling you?
Well, just watch out H2, and that number will dramatically change.
Could you give us a color on how dramatically will it change? If you could,
It's very simple. In the C&E business, typically, it is based on the contracts.
Okay.
Or even the A&M automotive OEM, it is based on the contracts. Every contract has a delivery time frame. And in the C&E particularly, I'm talking about today, there are timelines which are meant for Q4 of this H2.
All right. So, and what would the quantum of those deliverables be?
Well, our A&M and C&E, if you look at it carefully, it is a 50%, 50%. Okay.
Got it.
Right.
Okay. So that should explain. And on margin, or rather on M&A, you have almost 600 crore of cash on your books. Are you looking at any prospects?
Well, first part is we are investing in drone, which is hitting our P&L. We are investing in consumers, so these are organic, and we believe that both are required as an organic investment. The third one, you already just now must have seen our press release talking about a JV with Hyundai company. So there will be a $4 million investment there too. And all this are going to lead to a much better, quite a decent and quite an interesting future. This is the first time MapmyIndia has entered the international market.
Right. So will you have to change the branding as well, or will you still call it MapmyIndia? Even if
the brand for international is Mapples.
Oh, okay. Take that point.
See,
Thank you
the
so
brand
much.
already for consumer is Mapples.
Right. Yes.
All right, Mr. Verma, take your point on that. Thank you so much for sparing time and joining us. Wish you good luck for your international foray and for the rest of the financial year as well. As we slip into a short break, here is a programming note. As CNBC-TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit. On the 14th of November, starting 10 a.m. onwards, a power-packed day with several panels focusing on India's economy, digital landscape, markets, entertainment, and a lot more, only and only on CNBC-TV18. Welcome back. Another moving stock on the positive side today is Biocon, and that's after his Bengaluru facility was given a VAI status by the US FDA. Vinny is joining in with more details. Vinny, very strong reactions on Biocon.
Absolutely strong reactions, and the merit comes in as well. Voluntary action indicated as a positive side coming in for the company from the US FDA. Now, this facility, the inspection had taken place somewhere around in July, 15th of July to 26th of July. So because of this facility getting a VI status from US, this means this paves way for more product launches, product approvals coming in from the US FDA. The company was also has already received regulatory approvals from the EMA and many other international regulatory agencies, and this will pave way for them for some of the drug launches, important ones that they were watching out for. So it'll be key to watch out for here. Very positive move for the company in terms of the launches and approvals expected from the US FDA, and they're already manufacturing products for other regulatory markets. So as of now, a big news coming in for Biocon, 6%, 7% uptick that we're seeing in the stock.
All right. The other one we'll be watching out for will be Hindalco reporting its second quarter numbers. Nigel, what are the street expectations?
Well, we're going to look at the standalone numbers because we already have the Novelis's numbers, which were fairly disappointing, and the street is a little bit skittish because they've withdrawn their guidance. So standalone means we're looking at the India business. Now, in terms of the numbers, we're looking at the top line growth model as flattish. However, the operating profit will improve on a low base. just keep in mind that the standalone numbers that they report doesn't include the alumina business, the Utkal alumina business. So that's a bit of a delta that plays out. So the key way to look at it is you will look at three big numbers. One is the aluminium EBITDA. And that we're expecting it to come at around 3,274 crores. This is including the alumina business. So aluminium business on the whole should be around 3,300 crores. Point number one. Point number two is the copper EBITDA number, will come down a little bit. Should come at around 630 crores. And the third number you look at is what is the consolidated net debt. And in case they give any kind of guidance with regard to Novelis, because the street was very disappointed that they didn't give a band as well. Volumes will be more or less flattish for aluminium because it's functioning at peak optimum levels, while for copper it will be a little bit low, it'll be down by close to 10% on a year-on-year basis. Why does the EBITDA number look out? Commodity-related costs, well, they have come down. The e-auction prices as well have come down. So because of that, we'll see that the EBITDA number will look good. But more importantly, for Hindalco, we'll be waiting about a year out for the management. Why are they not giving a guidance on Novelis? When do they expect a recovery in that business? And capex as well as debt plans going ahead. So I think those numbers should be out in the second half of trade. That's normally the case, but I don't know whether today we'll see it actually post-market us.
Three important numbers and some very important questions that the management has to answer. So Nigel, thanks a lot for that. Keep an eye out on Hindalco. Time for a short break. Up next, Manisha Gupta joins in with Atul Chaturvedi of Adani Wilmar on our Commodity Corner. Stay tuned. We'll be right back.
Welcome back, and joining us now is Mr. Atul Chaturvedi to discuss on what really seems to be happening on the edible oil prices here. Mr. Chaturvedi, thank you so much for joining us. And I'll come to you with the World Food report that has come in from FAO, which says that the food prices globally are the highest in 18 months for the month of October. And when you look at the overall index, the details will tell you that the major surge really comes in from the vegetable oil index, a surge of 7.3% month on month, and it's at a 2-year highs right now. And within this as well, the fastest of surge really has come in from palm oil, where in last 1 month we've seen prices gain up by 18%, sunflower is up 10%, rapeseed 7.5%, and soybeans at 3%. Guilty as charged, clearly, when you look at edible oil as a sector. What's your sense on where are we headed from here, and are things going to get any better?
No, I don't think things are going to get any better in the short term. But having said this, we must understand that once the prices go beyond a level, it also results in demand contracting. And India being a very, very price-sensitive market, we feel that the worst, probably in terms of pricing, has already got priced in. And normally, historically speaking, this period between November, December, and January is the period when the Indian crushing industry and the Indian crushing industry is in full bloom. But that is not happening this year. And one of the reasons why we are not seeing huge crushing activity is that the outlet for soybean meal has got seriously impacted because of the impact of DDGS and all the other cheap meals. And secondly, even rice bran processing, which is very, very active in these months because the Kharif crop is already there. So that is also impacted because I do not know the reasons why we have banned the export of de-oiled rice bran. So both these are getting affected. Groundnut and mustard probably are the only saviors as far as the Indian consumer is concerned. And the only good thing is that we have groundnut, which has now become an oilseed again. Earlier we were bracketing it as a dry fruit, but now the edible oil prices as far as groundnut is concerned are much more manageable. So we would probably see groundnut again making a big impact in terms of availability and in terms of crushing. But having said this, Indonesia is talking in terms of 40% blending from 1st of January, and they're also talking in terms of 50% blending by 2028. So I think Indians should brace for higher levels of prices, but that there's a silver lining to it as well, because with higher prices, you would probably see Rabi mustard planting very, very aggressively. So my take would be, if the politicians have to really seriously look at it, there's no reason why India should be promoting biodiesel from imported palm stearin and PFAD. It doesn't make sense, because importing it and then converting it to biodiesel, you only convert things into fuel in which you are surplus.
You have excess of, yes.
Yeah,
Oh, well, yeah.
that is something India needs to look at.
So, Ms. Chaturvedi, as you said, the prices are not expected to come off very sharply from here. We're looking at 5,100 of palm. I mean, we all talked about on how the palm prices will go higher, but 5,100 with estimates of 5,500 now. How do you read that? And going forward now, since you're not expecting the prices to come off, but how higher are you anticipating prices from here for some of these edible oils?
No, this is basically the demand period for Ramadan and the Chinese New Year. So prices would remain relatively strong. And the other thing is that the Malaysian numbers have also come off, and Malaysia now has only about 1.8 million tons as closing stock. So all these are positive. But my take is, beyond 5,200 or 5,300, mustard will find it difficult to go up too much. There's a lot of soybean available in the world, and the soybean is what is bringing or ensuring that mustard remains range bound from these levels. Yeah. So I think the upside potential from this level is relatively muted at this point of time, I would say.
All right, Mr. Chaturvedi, thank you so much for sparing time and joining us on the show. Manisha, thanks a lot for joining in as well. Time to call it curtains on this edition of Halftime Report. But as CNBC-TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the Global Leadership Summit, on the 14th of November, starting 10 a.m. onwards. A power-packed day with several panels focusing on India's economy, digital landscape, markets, entertainment, and a lot more. Only on CNBC-TV18. Business Lunch comes up next.